Chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you very much, Mr. Chairman. And Vice Chairman Quarles, thank you. I think in your analysis, the response that you gave in terms of the regulatory community and what you did not see coming, it's partially true, but there was one thing the regulatory community did see coming and tried to do something about. It was the over-leverage of the GSEs, Fannie Mae and Freddie Mac, which reached 100 to 1. And in 2003 and 2004, I had legislation that tried to control for systemic risk, tried to transfer the authority to the regulatory community to take down that over-leverage in terms of those portfolios. And the regulatory community, the Fed in particular, was very supportive of that. We could not get that legislation through. I would say that they saw that coming. What perhaps they didn't see coming was also the investment banks, the four big investment banks, in doing their own modeling, had leveraged up their ratio from what should have been 10 to 1 to probably 30 to 1. Mm-hmm. And so the combination, first housing collapsing with the GSEs, and then on top of it, the big investment banks. I think that was a major blow here. I think what we're rediscovering in this generation is that this cyclical nature of the economy, because we failed to maybe adjust or regulate for these kinds of problems, are with us. And I think, unfortunately, maybe Washington tends to exacerbate in some ways, maybe exacerbating, rather than mitigating the booms and the busts. And I just wanted to ask you about that, because Washington is willing to come in and scale back capital requirements, right, when times are good. When times are bad, as we saw during the last crisis, Washington overshoots and limits the ability of banks to aid in the economic recovery. And we all saw countless examples of that with community banks. Mm-hmm. What is your view on regulation in terms of the economic cycle? Where do you think we are in the cycle, and how does that impact your assessment of regulatory changes, especially now as it relates to capital?
So those are extremely good questions. In general, banks should, and I think that they are, build their capital during the good times so that they can survive stress when it comes. And we know that there will be periods of stress in the future. I think that it's an open question. There are regulatory tools that are designed to try to provide those counter-cyclical incentives. The stress test is one of them. It becomes, as asset values increase, as times become good, the stress necessarily, if you assume that asset values are going to fall to a certain level, that stress is going to be greater, and that provides a certain counter-cyclical incentive. There are other tools that we could use. At the same time, the efficiency of the system is supported by predictability. The ability of the CFOs and the banks to predict how their bank ought to respond to the overall regulatory system, and balancing that is the difficulty that we wrestle with.
Let me ask you another question. Is it possible for businesses around the world to take advantage, you said, of the fact that we're in a world of opportunity, but it's an opportunity that's unbalanced? The developed world will face strong, significant headwinds for quite an amount of time. The emerging world has both robust growth and growth that's being driven by consumer consumption. So that was your point. Shouldn't we be looking outward to the emerging world for growth? We've got 5% of the population, 25% of the GDP. Shouldn't we support a renewed interest in the Trans-Pacific Partnership as a net positive for the U.S. economy in terms of that engagement? Just your view on that.
Well, the Fed's responsibility, I think that the Fed's responsibility is not trade partnerships, but in general, certainly the United States has benefited from an open trading system and from open trade, and that has been in our interest over a long period of time.
Thank you, Vice Chairman Quarles, very much. And Mr. Chairman, I thank you as well for this hearing.